Hey everyone, and welcome. Today we're diving into one of the most powerful yet simple tools in any analyst toolkit, the Trendline. You've probably seen them everywhere, right? On business reports, financial charts, but these little lines do so much more than just connect some dots. They tell a story. So take a look at this. At first glance, it's just a mess, right? A total jumble of data points that looks completely random. But what if I told you there's a story in there, a clear direction hidden inside all that chaos? The question is, how on earth would you find it? You find it with a single line. See that? A trend line just slices right through all that noise, and suddenly the underlying pattern becomes crystal clear. It literally turns chaos into clarity. So let's break down exactly how these things work. Here's our game plan. First, we'll get down to the basics of what a trend line actually is. Then we'll meet the whole family of different trend lines, because there's more than one. After that, we'll see how they're used in two totally different worlds, data analysis and financial trading. And to wrap it all up, we'll get our hands dirty and learn how to actually draw them the right way. All right, let's jump right in. Section 1, what is a trend line? From chaos to clarity. So at its heart, a trend line is just a visual summary of your data. You might also hear it called a line of best fit. Its job is to cut through all the little insignificant ups and downs and just show you the big picture direction. It makes it way easier to spot a trend and even to make some educated guesses about the future. Now, trend lines really live in two different worlds. In the world of data analysis, for business or research, the goal is all about looking backward. It's about summarizing what already happened to understand it better. But in financial trading, it's the complete opposite. Traders use trend lines to look forward. They're trying to anticipate where the market is going next. But, not all data tells the same story. Some trends are straight, some are curved, some accelerate. So naturally, we need more than one type of line. Let's meet the family of trend lines. And it's a pretty diverse family. You've got your basic linear line. That's for steady, constant growth. Simple. But if your data has these hills and valleys, you'll need something more flexible, like a polynomial line. If your data is just taken off like a rocket, you'll want an exponential line. And for growth that starts out super fast and then starts to level off, a logarithmic line is your best friend. Choosing the right one is absolutely crucial. A straight line is just not going to cut it if your data is curving like crazy. So the big question, how do you choose? Well, first, you just eyeball it. You look for the line that seems to hug the data points the best. But for data analysts, there's a more scientific way, a score called the R-squared value. Think of it like a grade for your trend line. The closer you get to 1 or 100%, the better the fit. It's like an A+ for your line. Okay, let's dive into that first use case we talked about, data analysis. This is all about finding that clear signal that's hidden in all the noise. In business and research, these lines are frankly indispensable. They help you see patterns you'd otherwise miss. They're fantastic for forecasting future performance, and they're great at spotting weird outliers, those data points that just don't fit and need a closer look. And maybe most importantly, they help you tell a clear, compelling story with your data. And remember that R-squared value? It's a score from 0 to 1. If you get a score close to 1, it means your trend line is a fantastic fit and it's got some real predictive power. But if you get a low score, well, that means your line is a pretty poor match for what the data is actually doing. Okay, now let's switch gears. We're leaving the research lab and heading to the trading floor. Because here, trend lines aren't just about understanding the past, they're all about trying to read the market's mind. In the trading world, it really boils down to two fundamental lines. You've got your uptrend line. You draw this below the price, connecting all the rising low points. It acts like a dynamic floor, or what traders call support. Then you have the downtrend line. This one goes above the price, connecting the falling high points, and it acts as a dynamic ceiling or resistance. I love this analogy because it captures the idea perfectly. Think of the price as a car on a highway, and the trend lines are the barriers. In an uptrend, the price tends to bounce off that support barrier below it. And in a downtrend, it often hits the resistance barrier above it and gets pushed back down. And this leads to some really classic trading strategies, like the trend line bounce. It's pretty straightforward. A trader spots an uptrend, they draw their line, connecting the bottoms of each price swing, and then they just wait. When the price eventually pulls back and touches that highway barrier, they look for a signal that's about to bounce, and that's their cue to enter a trade, betting that the trend is going to continue. Of course, none of this is going to work unless you draw the lines correctly. And trust me, there's both an art and a science to getting this right. Okay, here is probably the single most important rule: validation. Anyone can connect two random points, but a trend line isn't really considered valid until it gets a third touch. That third point is the market confirming that yes, other traders see this same line and they are reacting to it. That's when it becomes real. Now this brings us to the great debate, the question that every single trader asks when you draw your line on a candlestick chart. Do you connect the wicks, those thin little lines, or the candle bodies, the thicker parts? And the answer is actually really simple. You draw the line that gets the most touches, period. Sometimes that means you're connecting the wicks, sometimes it's the bodies, and a lot of the time it's a mix. The real key here is to stop thinking of it as a perfect, precise line and start thinking of it more like a zone of support or resistance. Finally, let's talk about the common mistakes to avoid. First, don't force a line where there just isn't one. Don't draw it right through the middle of the price action. And remember that last point. A line with only two touches is just an idea. It is not confirmed. You need that third touch before you should trust it.